So today is October 18th, 2022, and we have Jason Droback with Neo Home Loans. Hey, Jason.
Hey, everyone.
Thanks for joining us.
Yeah, thanks for having me here.
So Jason has a special presentation for us today. He's going to talk to us about some 2-1 buy downs. Is that correct?
Yeah, I'm going to talk about the different types of buy downs out there. You know, there's permanent interest rate buy downs, and then there's temporary buy downs, which you just referred to as a 2-1. I think there's a lot of just confusion about where buy downs make sense, where you can use them, how you can apply them. So I'm going to walk you through the comparisons on each side.
Awesome. Well, let's get started.
All right. So seller paid rate buy down strategies explained here. So again, as the market continues to balance, you know, we're seeing sellers experiencing offers from buyers with a reduced price, right? So buyers are reaching out to sellers wanting to reduce price on their home. Again, for most people, the lever that they automatically go pull when they're looking for negotiations with the seller is to reduce price. But for most buyers, price is not the problem right now. Affordability is the mortgage payment. Okay. With interest rates having gone from about 3% to 7%, affordability is what's changed so drastically in the last less than 12 months. It's not the price of the homes. So if we're adjusting price, we're not pulling the right lever for somebody who's using a mortgage. Okay. We want to choose the lever that's going to change their affordability, change their payment. And that's what a seller rate buy down does. Okay. So let me walk through a couple of examples. So when we're doing a seller paid buy down, there's two types of buy downs. So again, what this means is we're going to reduce the interest rate that's available in the market today. So on one end, we can do a temporary buy down, which is this left-hand side of the screen here. Okay. And on the other side, we could do a permanent buy down, which is on the right-hand side. So I'm going to walk through the differences of how those each work. Okay. So on the temporary side, what this is often referred to is a 2-1 or a 3-2-1 buy down. Okay. What that means is with a 2-1 buy down, your interest rate is reduced 2% the first year, 1% the next year, and then reverts back to your original note rate. Or with a 3-2-1, it's 3% off the first year, 2% the next year, 1% the third year, and then also reverts back to the note rate. So it's a temporary reduction in interest rate. It will go back to the original interest rate available that you originated the loan on. Okay. Now, a temporary buy down can only be funded by the seller. Really important part here. Okay. The buyer cannot fund a temporary buy down. Okay. So the entire credit for this buy down has to come from the seller or the builder or a combination with the realtors. It cannot come from the buyer's funds. Okay. That's a big delineation from doing a permanent buy down where you can use buyer and seller funds to originate that buy down. Okay. Third piece, a temporary buy down can only be used on either a conventional loan. So those are sold back to Fannie Mae or Freddie Mac, or on a government loan. So your USDAs, your VA, and your FHA loans. You cannot use a temporary buy down with a jumbo loan product. Jumbo loan investors do not allow temporary buy downs. Okay. Now keep in mind, again, where this is probably going to be most useful is in high balance conventional loans. So in Summit County and Wasatch County, we can go all the way up to 980,000 this year. My anticipation is we'll see that loan amount climb to probably around about 1.1 million by next year, based off home prices. But again, cannot be used with a jumbo loan, can only be used on conventional or a government. Fourth piece, on a temporary buy down, the buyer, the client, still has to qualify based off the note rate. So if the note rate today is 7%, we're going to temporarily maybe get them down to 5 or 4% with that 3-2-1 or 2-1. Client still has to qualify at the 7% rate because that's what's going to originally revert back to at the very end of that temporary buy down. Okay. Temporary buy down is going to create the highest amount of upfront savings of any strategy. Okay. I'm going to show you guys some math on this. It could create a huge amount of savings if we're reducing somebody from 7 to 4%, right? That's an enormous reduction in interest rate. So this is the strategy that's going to get somebody the highest amount of savings on their affordability. The sixth and final piece of temporary buy downs, and I really like this part. So what happens is when we do a temporary buy down, there's basically a separate escrow account that's created at closing And that goes to help with each mortgage payment to fund the difference between the actual payment that's supposed to be made at the original note rate versus what the client's making during the temporary buy down. Let's say the client ends up refinancing a year and a half into a 3-2-1 buy down. So if only used half of what's in the escrow account, they'll basically get that netted against their loan payoff when they refinance. So for instance, if there's 10 grand left in the escrow account that's funding the temporary buy down and we pay off that loan early through a refinance, you'll actually get a reduction in your total loan amount by $10,000. Pretty cool little feature to the temporary buy down because those funds are not getting wasted. Okay. So let's switch on to the other side and let's talk about permanent. So again, instead of a temporary reduction, this permanently reduces the interest rate. So for instance, we go from 7 to 6%, you always are going to have that now 6% rate for the life of the loan. What's nice about a permanent buy down, it can be funded by both buyer or the seller side. So if we can't quite get enough credit from the seller to fund the temporary buy down, we can always pivot towards a permanent buy down and use that in conjunction with whatever the buyer wants to pay as well. You can use a permanent buy down with any investor, any loan product. Okay. So we can use it with jumbo. We can use it with our non-QM, our non-traditional mortgages where we use bank statements or, stated income products can also be used with those products. Okay. So more flexible on where you can apply it. The clients also are allowed to qualify now off the lower interest rate. So if we've got somebody who doesn't qualify at 7%, but does qualify at 6%, we probably want to use the permanent buy down instead of the 3-2-1 because again, it's a permanent now interest rate. We can qualify them at a lower rate. Whereas with the temporary, we know it's going to revert back to that 7%. Client has to qualify at that 7% rate. And then the last piece I wrote on here, this does create more buying power than a price reduction, but not nearly as much as a temporary reduction, temporary buy down. So let me stop there. Any questions for the three of you in the comparison chart between the both?
My main question is about the permanent buy down point 4. Clients can now qualify off a lower interest rate. So like if someone's looking at homes and they're punching above their weight, can they still ask, they could talk to you about, well, would we qualify for this at 6%? And then we could ask for that in negotiations.
Exactly. That would be our strategy walking into it. Say, hey, look, we got to get you to 6% to qualify, right? Therefore, as part of and let's just say they don't have the assets to fund that buy down either, right? So then we're going to ask the sellers as part of our strategy. We're just going to make that part of our our offer strategy. Hey, we need to ask the sellers for 10 grand, 15 grand, 20 grand, whatever it is based off the loan amount that we need to make sure we get you down to that interest rate to ensure that you qualify on the back end. So we can certainly run the pre-approval that way, and that can certainly be part of our strategy and offer process. Good question. Nikki, Jeff, any specific questions on the comparisons there?
No, I think I understand. This looks great.
Cool. All right, let's move on here. Go to the next screen. And I just wanted to show you guys some math on how these each work, okay? So this first column right here, this is doing kind of $1 million purchase right now, 20% down. Fortunately, guys, we are at about a 7% interest rate today. So taxes, insurance, all in our area here, you're kind of an all-in payment of about $6,000. Again, total cash to closing with your closing costs and escrow account is a little over $200,000. Now, if we went to the sellers and asked for a 3% credit, now I did that pretty purposely. I'm going to show you guys a different chart that shows you the amount of concessions you can ask a seller for. But a lot of times 3% is going to be the limit for jumbo, and that's going to be the limit on sometimes of conventional. Okay. So that's why I use that amount. But again, let's say we're asking for a 3% credit. So instead of asking for a $30,000 price reduction, we ask for a $30,000 seller credit to buy down the interest rate. That gets us down to about 6% in rate. Right there, we created about $500 in monthly savings for the buyer. Pretty substantial, right? That's a pretty good amount of monthly savings for the buyer there. That might be the difference in them qualifying or not qualifying for the mortgage. That's a permanent buy down. This rate's not going to change on the client going forward. Okay. Here's a 2-1 buy down. Okay. So what this means, again, this interest rate is going to start at 5% for the first year. Next year, it's going to go to the 6%. And once it's all finished with a temporary buy down, by the third year, you're reverted back to the 7%. But during that first year, you've now got the payment a full $1,000 lower than you did at that 7% interest rate. It's a huge amount of savings for a buyer during the first year of getting into a home, right? So that's a temporary buy down. And again, since the buy down has to be funded all by the seller, in general, a 2-1 buy down takes about 2.3% from a seller credit. So this is actually less than what we needed from a permanent buy down on the seller credit side. Okay, so you need about 2.3% from a seller credit to fund a 2-1 buy down. And then fourth and final strategy here, this is a 3-2-1 buy down. So again, interest rate the first year comes down to 4%. So you're all the way down $1,500 less for this buyer than what it's going to revert back to after the third year. So this is the first year's payment, second year's payment, third year's payment, fourth year, and the rest of the loan, it would come back to this. Again, as we were talking about as we started this meeting, I think maybe before we started recording, my anticipation is we're going to see lower interest rates across the market in about a year, maybe less than 2 years. Okay, I actually think it's going to be around a year when we hit the end of 2023, once inflation abates. So if the client got this beautiful $1,500 less payment for the first year, then we refinance them. Let's say if we never get back to 4%, we be back to 5%. We get them back to $49.19. They never had to be anywhere close to this $6,000 payment. Cool. I'm going to stop there. Any questions on the numbers there?
Yes, I hate to be the calculating person here, but if they're buying $1 million home, and we want to go with the 3-2-1 buy down, that did I do the math? It's like $46,000 that gets paid. Okay, say that happens and they refinance a year from now, and when you say, okay, interest rates are back down at 5% or whatever that number is, does that remaining 30, whatever amount of money is left in that pot, goes to pay down that principal? Okay.
You got it. Yep.
So the real sell is, instead of doing a $50,000 price reduction, the buyers are asking this in lieu, and that money is not funny money. It actually goes towards and then gets credited to the actual principal amount. So in essence, it really is it could be used a year from now as like a price reduction, so to speak.
Exactly. Yeah. It's kind of the best of both worlds. Because the other thing to remember with the permanent buy down is we go to refinance in a year, right? Yes, you got the lower payment for a year, but we still paid 3% from the seller side to get it. We may have not reached the break-even period on that in terms of what the seller paid versus how much time you sat in that payment. That's where the temporary is so nice, because you're going to get those funds back to apply towards your principal.
Right.
Yeah.
Thank you.
Yeah. Dave, Jeff, any more questions you want me to answer on that? Oh, you're muted, Jeff.
I think this shows the value of the client meeting with you to find the program that works the best, so that when we write it up, we know exactly how much to ask for.
Totally agree. You do not want to go into this willy-nilly or without a good pre-approval and strategy derived, right? Because one, we may not ask the seller for the right amount, which case then we get into transaction. We can't actually fund that, right? That's a pretty big letdown. Yeah. Or maybe we ask for too much, right? And now we've got funds left over on the table. So yeah, this is really a good idea to get this nailed in before you ever go look at a home as part of your pre-approval strategy, just so you know where you want to land before we even step foot in a home. So that's a great point. David, do you have anything to add before I move on?
Not right now. Thank you, Jason.
Cool, no worries. All right, we go to the next screen here, guys. I just wanted to also kind of give you an idea of when's the best time to use this. And that's kind of what we were just talking about. So with the temporary, if the client wants to qualify at a higher rate, but wants upfront savings for the first 1, 2, or 3 years. So again, if they can qualify at that higher interest rate, but we want to create that incredible savings for the first few years of the loan. Okay. When we also want to use a temporary is when we can ask the seller to fully fund that entire buy down. Okay. If we can't get that full amount from the seller, or they're being wishy-washy, we probably just want to lean on the permanent buy down, since we can't count on them funding the entire piece. Remember this, the buyer can't fund the temporary buy down in any capacity. And again, if we're ending up with a jumbo loan or some kind of non-traditional loan, temporary won't work with those. So again, we're just focused on conventional or government loans for a temporary buy down. Again, on the flip side, if we're doing a permanent buy down, this is where clients potentially can't qualify at the higher interest rate. We've got to get them to a lower interest rate. This is where the permanent buy down will let them qualify with a lower rate for better ratios. If the seller will only fund part of the buy down, the client can fund the rest or not fund it. That's up to you. But if we're not going to be able to get enough for a temporary buy down, we can lean on that permanent buy down. And again, if we're using a jumbo or non-traditional loan investor, so we also would want to lean on a permanent buy down. And the other thing I'll add in here, some clients just simply don't believe we're going to see lower interest rates, right? In which case they might want to lean on the permanent one in that case as well. If they don't think my judgment is perfect on where the rates are going to go in the future, don't believe Jason, that's fine. Lean on the permanent buy down as well. Okay. Cool. I'm going to move on to the next screen here. And this one is more for you guys as the realtors, but this is a really clever chart we came up with that tries to show you the maximum amount in seller concessions we can ask for based off the loan program and based off the down payment and occupancy. Okay. So for instance, we've got somebody using a conventional loan. So again, we can use those all the way up to about $1 million in Summit and Wasatch County. Let's say they're purchasing it as a primary or secondary home. And let's say they're doing less than 10% down. So let's say they're just doing maybe a minimum 5% down program. Well, in that case, we can actually only get a maximum of 3% seller contributions, seller concessions. That means right off the bat, can't use a 3-2-1 because we need 4.6% for that one, right? So in that case, can only use a 2-1 buy down or a permanent buy down. But if the client says, oh, I can actually make between 10 and 25% down payment, still doing it as a primary secondary home on a conventional loan, we can now ask for up to 6% from the seller in concessions. Now we can introduce a 3-2-1 buy down back in there. Change. If we look at an investment property, remember, doesn't matter. You're always capped at 2% on an investment property and seller concessions on a conventional loan. FHA, you basically get 6% across the board. Remember, FHA is only for a primary residence. Same with VA and USDA. Now, VA is the most flexible. We can actually get basically almost unlimited paid closing costs or points paid by the seller, and then still get 4% concessions from the seller. And the VA is really weird. They'll let us pay off debt from the buyer side, from the seller, to help them qualify. So we could actually have the seller pay off loans for the buyer side to help them qualify on a VA loan. Really cool little trick on a VA loan. And then USDA also limits you to 6%. But this chart is in here, guys. So if you're quickly sitting down with a client with another lender potentially, and they're not answering the phone, right? Can't get a hold of anybody at Saturday at 6 p.m. How much are you putting down, client? We're doing a conventional loan. You've got 10%. You've got, cool. We can use 6% seller concessions. Always, again, you can reach out to me, but just as a little handy chart, this is going to be in here for you guys. So you don't trip yourselves up and ask for more in seller contributions than we can actually apply towards that loan. Any questions, clarifications on that?
That chart's fantastic. Quick question on VA FHA loans. With the assumability of those, are you seeing that right now because of the rates could be so much lower than the going rate?
It's a great question. I think we're going to see a lot more. So really, FHA loans, not really assumable. It's in the language, but really, I've never seen an FHA servicer allow an assume an FHA loan. On the flip side, VA, I have seen those be assumed, and I think you're going to see an uptick in those because yes, there are VA now people sitting in 2.5% rates, right? And if the new client can get a 2.5% rate and they're very tight on their ratios, that might be the difference of them getting that home or not. So I do see assumptions starting to probably increase a little bit. That being said, we're still probably talking about less than 1% of the entire mortgages that are out there.
Hard to line up,
very
yeah.
small fraction. So,
Okay, thank you.
yeah, good question. Cool. Anything else on those slides, guys? Cool. Let's move on. Okay, and then I just wanted to give you guys a couple of key pieces of data because I think if we're going to introduce, especially a temporary buy down, we want to give the clients confidence that we're not just going to, hey, here's your temporary rate and payment for a little while, see you in 3 years, and hopefully you can afford that payment at that point, right? We want to give them some data and some really good confidence that they're probably going to be able to refinance their loan in the short term. So I've got a couple slides for you guys on why I think that's going to be pretty prevalent and coming. So again, the first piece, and I was talking about this pretty heavily at the beginning of our slides here, but this is what inflation is doing versus a 30-year fixed mortgage rate. Traditionally, inflation goes up, so do mortgage interest rates. Inflation goes down, so do rates follow that, okay? And again, the big reason you see mortgage interest rates go up when inflation goes up is, remember, when inflation is going up, you're eroding the value of a bond or of an asset, right? And remember, a mortgage bond, which is basically a collection of thousands and thousands of loans, couldn't come due for 30 years, right? Because it's a 30-year fixed mortgage, right? So you've got 30 years, you got to hold on to this asset. Well, if inflation's going rampant at 6-7%, you are getting the value of that asset stripped away very, very quickly by inflation, right? So if inflation is going to go up, mortgage-backed security premiums are going to go up as well to fight that long-term fight of inflation, okay? So that's what you're going to see here. Here's 30-year fixed mortgage rates. And again, this was through 2018. Inflation starts coming precipitously down into 2020. We know we basically hit all-time lows of inflation through COVID pandemic because supply chains were completely cut off and because the Fed was introducing so much money into the supply chain, okay? And that's where you saw mortgage rates plummet down to the lowest rates we've ever seen, okay? There's inflation at basically almost 0%, right in the middle of April 2020 there. Mortgage interest rates basically hit their all-time lows. Inflation starts to come back around in 2021 as the supply chain started to open up. Jerome Powell famously said, we think inflation is transitory. If you guys remember that from a year ago, that's exactly his comments, right? It's not going to be here for very long. Oops, misjudged that, right? Because we dumped so much money into the supply chain of the economy. So much money got dumped in there. Inflation went crazy, right? So too did mortgage interest rates. The point here is, as inflation starts to come back down, which I'm fully expecting over the next few months, so too will mortgage interest rates, as they're going to be really following themselves in parallel, okay? So as inflation starts to come down, we'll see lower mortgage interest rates. And I have an article in one of these slides that's going to actually have the Fannie Mae. So Fannie Mae every year comes out and does a projection for interest rates, and they're calling for an interest rate between 4.5% and 5% by the end of 2023. 2% lower than what we're experiencing in this market right now. So again, I wouldn't sell a temporary interest rate buy down to a client if I didn't think there was a really great chance we're going to see lower rates for them to refinance out of that potentially end rate. I do think that's coming on the horizon. So again, and then I just wanted to point this out. Price is not the problem for buyers right now. It's affordability. This is the Housing Affordability Index put out by NAR, so the National Association of Realtors. Again, the higher this goes, the more affordable it is for clients. And again, we had super nice affordability back in 2011, 12, 13, 14, 15, because again, home prices were so low after the Great Recession. Affordability stayed pretty good all the way through 2021 because interest rates were so darn low. Even though home prices were going up, interest rates had plummeted so precipitously. Now today, we're finally feeling the effects of home prices increasing the last few years, and now mortgage interest rates coming up so quickly. We've got a really low reading of home affordability. So again, this seller rate buy down is what's going to help us with affordability versus a price reduction. So the other piece that I'm seeing from clients, and we talked about this a little bit. So if I've told you that lower interest rates are coming in about a year, the natural inclination from people is going to say, I'll just wait, right? I'll wait for lower interest rates so I can afford in this market. Here's the problem. We're still well below healthy levels of supply of homes in the United States. This is national, okay? This is this year. We're basically sitting about 1.3 million homes available in terms of supply, okay? Look at just in 2019. Oops, my mouse. We had 1.5. In 2011, we had almost 2. An average over the course of the history of the United States is 2.5 million. We're still well over 1 million homes short in this country to reach a balanced market. Okay, so if interest rates go right back down, we're going to create the same pandemonium we just had in 2020 and 2021, right? Multiple offers on every single home because there's not enough of them, and interest and borrowing is now very cheap again, right? Clients are going to end up overpaying for homes again. They're not going to be able to ask sellers to reduce price or ask them to fund their seller rate buy down. So this moment in time, this next year, is actually a fantastic time to be a buyer, because we can do a temporary interest rate buy down. You can actually get your home without fighting for 5, 10, 15 people in every single home. And we'll develop that refinance strategy post-closing with you to make sure when interest rates come down, you're taking advantage of that. And that's about it. Questions or clarifications?
Fantastic. It's optimistic. I like it.
Warren Buffett came out with one of my favorite quotes of all time is, when everyone's being greedy, that's your time to back off, right? When everyone's being be fearful, right? And when everyone else is being fearful, which is what everybody's doing in this market right now, it's time to go be greedy, right? This is the time you're going to, I remember when I got into this mortgage business in 2011, everyone was like, man, it's a weird time to buy a home. And back then in Denver, you could buy a house for $150,000. Okay. Those same homes now are worth 800 grand. right? They've gone up 400% in 10 years. What a ding dong for me for not buying a house in 2011 because I was fearful of everybody else, right? I've learned that lesson. Now is the time to go be not greedy, right? But go plant those seeds, go buy that home. There's going to be another low point in rates. You're going to be able to refinance out of this high affordability. So
That's great. Hey, Jason, I had a question. Has the lending environment changed as far as like qualifying? Are they asking for more different? How about our self-employed people? Can you share more with what that feels like to go through the loan process right now?
yeah, for now, actually, if anything, the guidelines and overlays that we had during COVID. So remember during COVID, self-employed people actually had more rigorous guidelines to go through. They were wanting you to prove how is your business performing during the pandemic. So aside from having to do a profit and loss and balance sheet for the business, we were having to go get 3 months of business bank statements, which have nothing to do with the client qualifying on their personal loan, just to prove how their business was doing just in the last 90 days, to make sure it lines up with historical averages. So we were having to get really detailed. They've actually removed all those overlays in the last 6 months. So from the self-employed piece, it's actually gotten easier, okay? Now on the other side, I would say for your non-traditional mortgages, so people are qualifying maybe based off assets, qualifying based off bank statements. So again, omitting the tax returns and just qualifying maybe off deposits coming into their bank accounts. I would say that market has trimmed their risk exposure a tad bit, okay? Because they don't really want the more riskier loans right now in a rising interest rate environment. So, but otherwise, I would say your conventional and jumbo products, the actual qualifying has probably actually gotten a little easier in the last year versus getting harder. So that's actually good news.
Yeah, awesome. All right, guys, any other questions? Awesome. Well, thank you for your time today, Jason. We really appreciate the update and actually optimism. I feel like there's some conversations on both a buyer and a seller, right? It's a great time to be a buyer, but at the same time, it's a great time to be a seller in the sense that there are options. And that's always great to know that, you know, while buyers may be sitting on the fence, those savvy buyers can strike a deal with sellers that are motivated and ready to be buyers again. So awesome.
Totally agree.
Thank you so much.
Thanks for having me, guys. Really appreciate it.
Awesome.
Thank you.
Thanks.
Thanks, guys.
Jason, we'll have to, I'm intrigued. I'm going to stop the recording at that and I'll edit some stuff out and I'll share the video with you.
Perfect.
But I feel like this could be, we should just mark on our calendar and feel free to reach out to us anytime. Say it's, for example, like, oh, this is a great deal. I think the Keye team could appreciate learning this. Feel free to reach out. We meet every Tuesday at 8 a.m. So
Perfect.
well, not every, but we try 95% of the time to meet every Tuesday. See, Jeff is down in California and he still showed up. So that's good. And I'm actually home for once. So that's good.
Oh, that's amazing.
I know.
Leaves
So-
and I go. See how it is?
Starting to wonder. No, just anyway, will you email us this the PowerPoint and we can
100%.
stuff
Yep.
out of that and share. And then David, any questions?
I would say it's reassuring hearing a second lender I've talked to in 3 days talking about rates coming back down. Where, you know, it was Nanette, I spoke to her a few days ago and she was saying, well, you know, even though, you know, the Fed is hiking rates and we're going to probably see it continue up in the short term and the near, you know, medium to long term, same thing as Jason was saying, like below 5. I was still like, that's optimistic. And now I heard a second person saying it. I'm like, well, maybe not as optimistic.
Yeah.
So what do you see for the next couple of months? Because I read an article that said it's going up in November and December again, and pretty good jumps. Is that on the radar? Or
It really is going to depend on what those inflation readings come back out to. And I would also say right behind that, what the jobs report continues to say. It's really interesting. So the jobs report came out this last month and showed 260,000 jobs created. Well, if you actually dive into the numbers, you know what the funniest part of it was? 170,000 of those jobs were from 13 to 17-year-olds. So great job. We created some. Oh yeah, no, this is seriously what the Fed relies on. Like, it's amazing. Like, they're like, look at our jobs report. It's doing amazing. It's like, well, we created 3/4 of these jobs were obviously summer jobs, right? For 13 and 14-year-olds. These don't count. So really, if they truly pulled those out, the jobs report would look pretty gross this last month. Okay. Same thing for inflation. Okay. It's always a year over year reading. We're going to start seeing that get trimmed because we're finally going back now a year to when inflation started to spike. So I do think, again, the Fed's probably going to roll in this next meeting and do one more rate hike. I don't know if they're going to do 75 basis points. I wouldn't be surprised if they do a 25 or 50 basis point. If they do a 75, it's just because they still have no pulse on the economy, which is funny because 4 or 5 months ago, Jerome Powell came out and said, we basically now understand that we don't understand inflation. It's like, well, that's really concerning, guys, because you dictate all of the monetary supply in the entire world. So, and you guys don't even understand inflation. So again, these are the people who control money in our country. It's really frustrating. So, but again, as inflation starts to cool, they're going to immediately pull us into a recession. As they do, the Fed's going to do exactly what they know how to do best, which is just swing the pendulum all the way back to the other way, and they'll start decreasing rate hikes. But we don't even really need them to start decreasing short-term interest rates for mortgage rates to go back down. As soon as inflation's quelled and that starts showing lower readings, we're going to start seeing lower mortgage rates because ours don't necessarily follow what's happening with short-term rates. As inflation comes down, investors are going to feel a heck of a lot better about their long-term mortgage-backed security investing. So,
Okay, cool.
but yeah, I would expect rates to stay around the 7% range, probably for the next 30 to maybe 90 days. But I would start to see them start to retreat as we go into next year, especially as we start to see more and more news articles about the recession is finally here, right? I already know it's here. We just had back-to-back quarters of negative GDP. And then again, for the first time, the Fed comes out and says, well, every other time we've marched a recession is back-to-back quarters of negative GDP, but we're not going to quite do it this time. So they're changing the goalposts again. So it's just pretty funny.
Yeah, frustrating.
And it's also like, man, you guys dictate like how people get, lending and how people get homes and savings rates, and you guys don't really truly understand what's happening in the economy. It's really baffling. So
Yeah.
do you know the Fed? Also, another funny thing, there's 17 Fed chairs. Only 2 of them have ever worked in private business in the private sector. All other 15 of them have only been public sector, right? They've only been working in education and colleges and universities. They've never had real world experience. It's like, come on, man, what is going on here?
Sounds like a government job.
Seriously, right? Not a bad one. I think it probably pays like $250,000 a year just to,
Yeah.
hey, let's raise rates. Hey, let's lower rates. It's cool. Let's do it, So,
Crazy. Well, that's all. While as crazy it is, sounds like things aren't as doom and gloom. And what you said correctly, like it's frustrating because there's no movement because buyers want to buy and sellers want to move because they're locked into these amazing interest rates. And I think time will tell, right? Like we have to go find those buyers and sellers that have to do the things. But I'm hoping, I don't want it to go back to the way it was because it's just there. While people are like, oh, it must be so easy. Nope, it was unrealistic expectations. And then they sell and they feel like you've shorted them. And then buyers are being squeezed for every dollar. I mean, none of that was fun. I mean,
it's
yes.
the most exhausting 2 years I've ever been through. It's just brutal. So.
I just want it to be fair. I feel like got a house, you want to move up, you got a fair deal. Selling it at a fair price, let's just keep that normalcy of like, why people, it's interesting and we could digress for a bunch, but home ownership is a pathway to wealth. I think the US got a little excited about it's the pathway to millions and really we need to set the expectation back. It's a way to have a roof over your head and a long-term solid investment. This whole I just made $100,000 on my home last week, like, so it just was made for a really unrealistic environment. So I'm glad things are pumping the brakes, and whether that's unfortunate for people who really have to have homes, kind of sucks for them. But at the same time, for those agents that came into the market thinking it was an easy deal, I'm hoping some of those go back to their normal jobs and we get back to just the professional people. Yep. And same with lending, right?
There's been a lot of yahoos who are like, oh man, this is an easy time to make money. I'll just do 10 refis a month, right? They don't really know what they're doing, nor do they have experience, right? So I'll be more than happy to see all those people matriculate out of the business.
Yeah.
So, it'll be good for everybody. So
yeah. All right. Well, have a great rest of your day. And Jeff and David, do you guys have anything else? We good?
No.
Good. All right. Thanks, Jason. We're gonna hang on for about 2 more minutes and wrap up our meeting, but reach out if you need us, okay?
Sounds good. I'll send you guys the presentation and then that link to that Fannie Mae article about interest rate
Oh,
projections.
great.
Okay.
Love to
Thank
share
you.
that.
Well,
Okay,
guys, thanks for
awesome.
having me. Have a great day.
Thanks, you too.
Bye.